All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I've been talking with my brother a little bit, and as many of you know, he trades. He's a geologist by education and has worked in the field, and so he tends to trade a lot of oil energy names. So I was picking his brain a little bit about them, and just I don't have any exposure in the space, but we do have a few of them on the challenge watch list. You've heard me make a few comments about Halliburton. So I thought I'd hop on and talk about the oil and gas sector. Is it buyable, investable, tradable? And what I'm looking at going forward, because I do think there are some interesting opportunities setting up, but not in the traditional or typical way here. But before we go look at it, the last comment he made to me, I think, sums up the market today perfectly. He said, "You'd think with three 100-point rallies since yesterday's close, the market would be up big." And if you look here, yesterday at 12:30 my time, 2:30 Eastern, we saw more than a 100-point rally into the close. Then, as Europe was getting ready to open it into the European session, we saw another 120, 140-point rally. And then, since the lows here today, we have seen another 130-point rally. So we have seen more than we have seen in the last 24 hours. We've seen three 100-point rallies on S&P futures, and today's market is up 19 points. So pretty incredible. Just pretty incredible. I don't know another word for it there. So Exxon, Chevron, these stocks have tanked in a massive way. Let's take Halliburton, for instance, and let's just clean up this chart. Here's the Halliburton tank. Halliburton had been on a downward spiral for a while here. I did a video talking about why Halliburton has probably bottomed here in September and October. And it is something that rallied a little bit nicely, but then some game-changing action happened. And when we think about the oil and gas sector, we need to understand that this isn't just about coronavirus. This is also a big part about Saudi Arabia and OPEC and Russia's involvement and the actions that Saudi Arabia took to basically damage not only U.S. production but Russian production, and to gain a stronger foothold in the global oil trade. And add a negative to them in the short run, certainly. In the long run, though, which is the end game they're looking at, it could be a big benefit to them. And when you think about oil production, whether you think about it from a company like Chevron or a company like Exxon, or you think about it from a country, each country, each company has a price of oil to which they're profitable. And if oil goes below that price, they lose profitability. So when oil prices were moving up above 100, what happened to stocks that, could only pull it out of the ground for $80 a barrel? Those stocks started to skyrocket because they were turning profits. But once oil dropped back below 80, those stocks were sold heavily because they couldn't make a profit. One of the lower cost producers here in the U.S. is Chevron. They have some fields out there that can pull it out of the ground for $11 a barrel. So they're able to make some decent money there. Saudi Arabia is a very low cost producer there, while other countries, it costs a little bit more. The U.S., the cost per barrel has been coming on down. But one of the reasons why the U.S. still buys a lot of Middle East oil is because they can buy it cheaper than they can pull it out of the ground. And so it's just one of those where the economics of it say, hey, go buy oil from the Middle East because it's just cheaper than pulling it out of the ground here. While the world has oil reserves out the wazoo, and we're nowhere close to running out of oil. It is one where different production costs change. But something's happened in the industry over the years, and that is that overall production costs have gone down because of new technology in terms of fracking and other instruments that have simply transformed the sector. So companies don't have to spend as much money on exploration, on drilling projects, and it's one of the reasons why companies like Halliburton and Schlumberger have struggled here over the last several years. So what about it now? I mean, the sector's in ruin. The sector is laying in rubble right now. Oil prices broke down below 20. They've popped up above 20 here, but this is something where oil prices at the beginning of the year were up above $60 a barrel and had been relatively stable for a year. They hadn't seen a lot of big swings in the price of oil, and then to just get absolutely annihilated in the span of in the span of 2 months, to see oil go from 65 down to 20. That's a huge shock to the sector, to the system of the energy trade around the world. You combine that then with coronavirus, and what does that mean economically, and supply, demand, all of that. You add, the uncertainty of the entire Saudi Arabian situation. And how is energy going to respond? Is it going to rebound the same way it has in the future or in the past? Probably not, because technology is different. Production costs are different. The number of reserves out there is just very different. People don't look at oil and go, well, it ultimately has to recover because it's a limited resource. It's not a limited resource in terms of, the new finds that have happened and the amount that's, out there. Natural gas used to be thought of as a limited resource, but natural gas is so abundant that, most of these energy companies, as they pull it out as a byproduct, they simply burn it off. It's not worth packaging. It's not worth saving and shipping to sell. And natural gas prices, they're about $1. And they're super cheap. No one's paying for natural gas. So what happens to some of these companies? Well, we've seen what's happened in natural gas companies like Chesapeake Energy. I mean, a stock that was once in the 80s, spent a lot of time in the 20s, broke down below 5. Bye-bye. Range Resources. This was a stock that was up in the 90s, now sub $5 here. Bye-bye. These aren't things that traditionally bounce back. When energy stocks and natural gas commodity stocks tend to break below 5, the chance of them recovering is very slim. There are a lot of stocks that I just simply cannot plot here on this chart. One of them that I can is Seadrill, because they keep reverse splitting. This stock was never 12,000 like what it says up here. It never traded at 12,000. It's just been reverse split to death. Reverse split, reverse split, reverse split, and it just keeps on going down. Once it broke down, it was done. We have countless number of energy names that look like this, but a lot of them you just simply can't chart anymore because they have gone bankrupt. Some that haven't yet, Transocean, rig. What's the value of drilling in deep water right now? It costs way more to pull a barrel of oil out of the Gulf of Mexico today than oil is going for. And oil needs to more than double to make these things profitable. They're not companies that are coming back. They're not companies that are going to rebound. So what about some of the bigger names that are going to survive, that tend to pick up some of the assets from these companies that go under? Here's another one, probably goes under, NOV, National Oilwell Varco. But what about the Exxons, the Chevrons, and the Conocos, and the Hess Corps of the world out there? As far as oil goes and the price of oil and the fundamentals of these stocks, I have no idea what to make of them. I don't know if they're buyable. Is Exxon buyable here at 30? Well, it has a massive dividend. It's cheaper fundamentally than it's ever been. But I'm not sure how the Saudi situation is going to play out. I suspect demand is going to return. I do suspect that oil is going to snap back. But oil snapping back and going to 40 is not the same as oil snapping back and going to 60. Have these things priced in $10 oil, or are they priced in $40 oil and need a snapback to hold the current pricing? I don't think there's a good answer to that question. I don't think I can answer that in a way where I feel comfortable throwing money at the group just because it's down big. Chevron has some cheaper projects out there, so I suspect Chevron survives, and I suspect ultimately they thrive in the future. But when is that going to be? There's just a lot more questions than answers. But there is something in the oil and gas sector that happens, and every time it happens, we see it ultimately come back. And it's something that doesn't rely on Saudi Arabia and Russia relations, doesn't rely on the coronavirus, doesn't rely on any of these shocks that have come to the system, doesn't rely on the price per barrel to pull oil out of the ground. But that's this thing called a crack spread. And the crack spread is called a crack spread because it's what refiners get by cracking an oil molecule. So refiners take a barrel of oil, they refine it, they crack it into multiple products. Gasoline being one of the big ones. Well, what's happening to gasoline usage right now? It's plummeting. It's absolutely plummeting. Jet fuel, right? Cars, when you look at the global economy and people self-isolating and all that other jargon that's out there now, or gasoline demand is falling, and gasoline price, the price drop in gasoline has been infinitely greater than the price drop in oil. It is something that has just fallen off a cliff here, and is lagging oil in a big way. Now the UGA doesn't fully show it, but this is an ETF that tracks it to a certain degree. If we go over to the CME Group website, we can see what the crack spread futures are. And these trade, they're not very liquid. They're not super tradable if you're looking to buy and sell. These are used mostly by institutions to hedge. But we can see what the crack spreads have been since 2017, summer of 2017. The crack spread was 18. That means if you're Valero, you take a barrel of oil, you crack it, you refine it, crack it, you can expect to make $18 a barrel. Not bad. Then that crack spread rose up into the 20s, $24 a barrel, $26 a barrel. Pretty nice. Crack spread goes up when oil prices go down or gasoline prices go up more than oil prices go up. It's that difference. In simple terms. It's a lot more complicated than that in terms of all the products, but just in simple terms, gas prices versus oil prices. Then the crack spread falls here in 2018. Drops all the way down to 16. What happens to these refining companies? They drop. They drop hard. Crack spread stabilizes, comes on back, pushes into the 20s. Here by January, February, what happens to these refining companies? Well, these refining companies do very well. In fact, if we take a look at Valero was up in the hundreds, tried to push up into the hundreds here. with the recovery in the crack spread, was doing pretty well. And then the crack spread fell off a cliff. And what did Valero do? They fell off a cliff. And the crack spread made one of its bigger drops in history. Not only for this month options and this month futures, but if we go to other months, we can see it's the same thing. It's the same plummet in the crack spread. This isn't just something unique to the March month or the June month or the April month. It has happened across all months. And so the crack spread is hit into some historical lows. And if you think about what's going to happen over time, in the short run, the crack spread can continue to deteriorate. But over time, what's going to happen to gasoline usage? It's going to come back. We're an oil society in terms of, gasoline refined product. The demand side of the gasoline equation is going to return to normal and likely grow going forward as populations grow. I know we have electric cars and some of those other things, but airplanes, boats, militaries around the world, it's just one of those where, an electric car isn't going to replace the need for gasoline. And so ultimately, the price of gasoline is going to come back. Oil prices will likely rise in that scenario. But they will not rise faster than gas prices. And so we can expect that the crack spread will improve, will snap back in a much stronger way than we can bet on the price of just pure oil or the price of just Exxon. So what companies are most exposed to the crack spread? Well, Valero, Phillips 66, PSX are two of the big ones that are out there. ConocoPhillips to some degree. Hess Corp to some degree, but they have a little more oil exposure, in Hess Corp and in ConocoPhillips. Chevron has some refining. Exxon has some refining. So if I'm going out and making a bet on the energy sector, am I going out betting on Halliburton, relying on oil and gas exploration and drilling? Or do I want something exposed to the crack spread to an area where we will see demand come back that isn't reliant on oil prices coming back? Well, for me, I want crack spread exposure. I haven't bought any yet. I'm not planning to buy any just yet. But for me, it's all about Valero. It's all about ConocoPhillips. And those are the two that I want exposure to, I want to trade when the dust settles. I've gone and taken a look at some of the option spreads for them. Things like a Valero here. If we come out and we just look at the implied volatility, it's insane. Valero tends to have a higher implied volatility, but the current levels are just mind-boggling here. That if we want to come out and bet on a little bit of recovery, you can see the spreads on the January 50 calls. It's 380 to 550. On the 55s, it's 286 to 435. The spreads are ridiculous. They're not really conducive for jumping into some sort of call spread here. And being able to say, hey, you know what, I can expect to get a really good price. And the reality is that something like a Valero is still at risk with crack spreads where they are of moving to 20, and the big rebound is back to 35. So I don't know that I want to get up into 50 and say, well, yeah, there's just going to recover back to 50. No, I'm not saying that we're going to have that sort of magnitude. But when they bottom, we are going to see them rally 100 to 200, maybe even 300%. But they need to bottom first. And when it comes to the energy and commodity sectors, what do we know about bear markets in energies and commodities? They tend to be extended, and they tend to overshoot by a lot. So things that maybe should bottom around 30 can overshoot down to 15, 12. Things that should bottom at 50 can overshoot down to 30 or 20. So as we look at this group, as we look at this sector, I think if I'm buying it long term, you force me to buy today, and you say, Jeff, you got to buy something. I'm going to go buy ConocoPhillips. That's what I'm going to buy. That's what I'm going to hold. That's what I'm going to say. Hey, you know what? I'm not super comfortable that I'm going to make money on this, but if it does dip to 10, it's probably coming back to 20. Valero's the one I want when things bottom, because when Valero rebounds, the rebound will be fantastic. It'll make one of those runs where it goes straight up for 20 to 25 days straight. I want to be a part of that, but it's not happening yet, and something that I expect to happen, but the timing on it still a lot of different variables, and we don't see anything on the charts yet to suggest, hey, it's ready to come in now. But keep those in mind. That's my kind of take on the energy sector here, kind of what I'm looking at. I'm not super interested in being a buyer of a Halliburton. It's too changed right here. Yeah, could it rebound? Could it rebound to 7.5, 8.5, 9? It sure could. But I do suspect that those rallies will ultimately get sold into unless we see something that changes oil prices in a massive way. And what is that? Well, that's war. We see war break out. We will see energy prices, potentially surge. And if you look at some of the incentives of Russia, Iran, some of the other countries that are getting hit pretty hard by energy prices where they are right now, it's not unfathomable to think that some war that ultimately disrupts oil supply could break out in the next 6 to 8 months. If that happens, that is a game changer. That does bring Halliburton back to life, because there will be much more U.S. North American drilling that has to happen. Schlumberger will come back to life. EOG Resources come back to life. But that's the scenario that has to happen for them to come back to life, in my opinion, and how I'm looking at that. Okay. All righty. Thanks for hopping on. Have yourselves a great one. I'll hop back on this afternoon if there's a signal. I don't think there's going to be a signal, but if there's a signal in the market vibe where we see a big change in the market internals, or we see some trade signals come in, I'll hop back on. But for now, nothing is really brewing on either front. We don't see any new change in the market vibe. We have had the market vibe numbers shift because of the rally in the bullish percent index. The bullish percent index has shifted and gone bullish, which is, you can say, is this a dead cat bounce for the bullish percent index? Now, we'll make that argument, but we have seen the bullish percent index bounce, but the market vibe has not triggered bullish or even gone neutral with this bounce yet. It is still one where the market vibe, the reading is -8 right now, and still a bearish reading. But should we get a change in the market vibe? Should we get a change in some of the trade signals where something comes in? Then I will jump on and make the trades happen accordingly. Again, thanks for being with us. Have yourselves a great day, and we'll talk to you later. Take care.